everyone. My name is Michelle Song, and on behalf of the Los Angeles Public Library, welcome and thank you for joining us this evening for Investing Basics. This workshop is part of a series of programs for Financial Planning Week, which was made possible by the Financial Planning Association of Los Angeles. Thank you to all of our financial planning volunteers. We will have financial education workshops every day this week, Monday through Friday at 6 p.m. The workshops are streaming live right here on LAPL's Facebook page and YouTube channel. You can sign up for a free private telephone consultation on Saturday, October 24th, with a certified financial planner to discuss your personal finance questions. This is a pro bono service offered by the Financial Planning Association of Los Angeles. To learn more about the upcoming workshops and to sign up for a free appointment with a certified financial planner, visit lapl.org/financial planning. A few housekeeping items before we begin. Feel free to ask questions during the presentation. Also, this is a public streaming program, so when you are chatting in the chat box or asking a question, make sure you do not disclose any private information. If you have more specific questions, consider signing up for one-on-one consultations on Saturday. Now I will hand it off to our presenter today, Ms. Katrina Soder.
Hi, everyone. It's a pleasure to be here. Thank you to the Los Angeles Public Library for hosting this event. The Financial Planners Association of Los Angeles is thrilled to be a part of this. It's one of my favorite times of the year. We get to do some financial education, and I'm really excited to start our Investing Basics presentation today. We're going to go ahead and show you some slides. So there we go. Slide number 1, already up and ready to go. So investing obviously is one of the concepts we aren't taught in school. And so today we're going to talk a little bit about the investing basics and how to be a smart investor. And specifically, what we'll cover is we're going to explore investing and investing concepts, explaining how investment fits into your overall financial plan, and then introducing some general investment strategies. And finally, we'll discuss ways to put these strategies into action. We will not make you a top stock picker. We are not going to provide insider information, and we won't recommend a specific course of action. So if you were hoping to get your day trading tips on this presentation, I'm sorry, but we'll have to disappoint you there. We are going to start by talking about the key concepts of what it means to be a smart investor. And there are a variety of different pieces that go together to make you a smart investor. And that first is saving, right? When we have savings and when we are saving, that is what gives us the wherewithal to actually be able to take some of that money and allocate it towards investing for our future. And that's really that next bucket there is investing. With investing then comes all of these other pieces that make up investing: risk and return, asset allocation, diversification, and asset location, how you're actually placing your assets and where they are held. And so we're going to go through each of these concepts today and start off with really diving into those so that you can understand how each of these plays a role in becoming and being a long-term smart investor, really upping your game for your future. So saving is the first step, right? And we're familiar generally with the concept of what saving looks like. It means putting money into a savings account or a money market account, should that be the type of vehicle you choose. And then you're going to earn some regular interest. These days, it's probably, even if you're in a high yield online savings account, somewhere in the range of 0.5 to 0.6, or the higher end interest rates. So you're going to earn some regular interest. The upside of that savings account is that your money is immediately accessible when you need it. You do not have to wait. You can pull it out immediately, and you know that your assets are safe because they're insured by the government. That FDIC insurance is in place with our banks. And those combinations of having the money immediately accessible and you know that you're safe because they're insured, that combines to create this savings bucket. And so ideally you want it to be earning a little bit of interest. I know there are some folks out there who might right now be in savings accounts that are earning as little as 0.01%. So definitely something to look at as you're thinking about your savings and your savings growth. The savings is key to creating the next step, which is investing, because the savings is what allows you to have an emergency fund and to protect you in case of emergencies in your life. Once you've gotten that savings account really set up and it's funded with 3 to 6 months worth of your expenses, should you run out of something or not have a job or be faced with a COVID pandemic, that's when then the rest of your assets that you're saving for your longer term future, we can start to talk about the aspects of investing. And so really you want to make sure that you've got enough in that savings bucket and that you're not just tempted by the investing side to put everything in there. Because if, for example, right when we've just lived through this with COVID, right when everything was really shutting down and people were being put into places of unemployment, that was also when the stock market was dropping. And so you don't want to be in a position where you're having to withdraw from your investments when you need emergency money. And that's the beauty of the savings account. Investing is there for our long-term potential. And the idea with investing is that we are buying assets for their potential to increase in value and provide income, one or the other, or sometimes both. So there are in assets that do both of those things. And we also expect a fluctuating rate of return. We saw that drop in earlier this year. It's recovered. That's this up and down cycle that happens with those assets. If you needed that immediate cash, you'd actually have to sell it at whatever it was currently trading at, basically the current price that the market, other people would buy it at. And so that's, again, reinforces this importance of having your savings account so that your savings account can provide your emergency fund and liquidity in case of needing immediate cash. There is the potential for losing as well as making money since these assets are not insured. So there is no FDIC insurance here. If the stock or the bond drops in price, there is nothing that's going to make you whole back to the original price you bought it at. And so that's another big difference. We want to make sure that we understand the risks that are inherent in investing as well as the upside and benefits. So here again is description of why we save versus why we invest. As you'll notice, everything on the left for savings is really our short-term goals, our emergencies, our vacation, things that we need sooner rather than later, and things that we want to make sure the money is there when we want it. Investing is everything that's long-term. Retirement, college for your kids, long-term goals. Anything that's going to be able to ride through the ups and downs of those fluctuating asset prices. That's something that can also impact with having a huge upside potential as well. That's what goes into this investing bucket. So these two buckets are what we use to identify what goes where. So we're not going to put our vacation fund into the investments, and we're not going to put our emergency fund into the investments. Very important. Key point there. How does this all play into the financial planning picture, right? Because financial planning is really creating a long-term plan for your future. It's comprehensive and it's systematic, and it ensures that everything that touches your finances is in order and working for you. So these here on the right are all of the things that we list as being part of financial planning and the overview of financial planning. So when we're looking at each of these pieces and putting them together, you'll notice one of those is investments because, of course, it impacts your financial future. That is true of all of these different areas here as well. Insurance, the benefits you receive at your workplace, taxes and tax planning, your retirement, and your estate planning. And so when we are using all of these different pieces and looking at them holistically, we're developing a clear plan for your future and for your finances that helps you feel in control of what's going on. And this specifically today, of course, we're talking about the investment piece, but the investments actually impact significantly all of the other pieces. Investments interplay with your tax planning, with your retirement, with your estate planning, even with your insurance and your employee benefits. So we're going to talk today really about the basics of that, and then you'll be able to hopefully understand specifically how that impacts the rest of your financial picture. It's important to recognize that for financial planning, the term I use with my clients is what you're doing with financial planning is you're trying on different futures. We try on different clothes before we buy them. Financial planning is trying on different financial futures before you choose them. And so this is going to be one of the pieces that helps with financial planning. And if you have more questions about financial planning, definitely come visit us on Saturday and speak to a CFP, a certified financial planner. I will also be volunteering on Saturday there. So that'll be something that can give you a more holistic picture of your finances, since today we're only focusing on this one section. So before you invest, it's important that you're clear about some of these other areas of your finances, because this step on investing is extremely important to do for your future, but you also want to make sure that you're doing it at the right time and not jeopardizing other areas of your finances. So you absolutely want to understand what's happening from a cash flow perspective. And what do I mean by cash flow? Well, I think of cash flow as a very simple equation. You have your income that's coming in, minus your spending, that's what you spend your money on to be able to live your life, and equals whatever's left over at the end is either positive or negative. If it's positive, it's savings. If it's negative, then it's debt, right? Then we're negative for the month. And so when you can get a handle on the income to expenditures ratio and making sure that that is working for you and that you have a positive balance at the end of the month, that's step one before we start investing. Step two is that cash emergency fund. We're really making sure you understand that the importance of having that savings account. It's actually been shown, research has shown that there is a significant improvement in your overall life satisfaction when you have an emergency cash reserve, because it helps you feel like you can withstand any shocks to your financial system. So building that cash emergency fund, we usually recommend 3 to 6 months worth of your expenses to be saved, so that if you were to run into an emergency, you have enough money there to get you through that emergency. Paying off expensive credit card debt is number 3, right? If you've got a huge interest rate over on your credit card and you're having to pay that down every month, then there's very little that your investments can be doing to outgrow what's happening on the interest you're paying on your credit card. So making sure you've got a debt repayment plan and that you're paying down that expensive credit card debt in specific will help make sure that you're prepared to start investing. And then number 4 is buying the right kinds of insurance. This can happen through your employee benefits. It can happen individually. Insurance is there as a layer of protection. It does not need to be a bad thing. I know some of us hate paying those insurance premiums every month, but insurance is there to make sure that you're okay, again, in case of emergencies. But this time it's like the really big emergencies, right? So when we have the right kinds of insurance, we're going to be protected if we become disabled, if one of the spouses passes away in a family and perhaps they were the breadwinner, if you have a health emergency, if you have cancer. So those are the kinds of big catastrophes that insurance helps to protect us against. So making sure you have the right kinds and that they're working for you is critical. And I will mention, I want to just sort of intersperse with a couple of stories here. I do think that the insurance here is a key component of this discussion, only because disability is actually a higher risk during your working years than losing your life. And so a lot of people don't recognize that and perhaps don't look at the disability insurance options through their employee benefits. I highly encourage you to take a look at that, both the short term and the long term. That'll be something that you can definitely ask your financial planner about on Saturday. And then finally, writing a will, at least making sure you've got some estate planning documents in place. Estate planning isn't necessarily only for you, although there are some benefits if you were to be in a coma of having your healthcare directive in place and making sure your estate plan is correct. Estate planning is for your family. It is saying to them, I care and love about you so much that I want anything that happens after I pass to be smooth for you and to not be a horrific disaster going through the probate courts and having to deal with everything and worrying about all of the details and not understanding what's going on. And so when you have a clear estate plan, it helps protect your family. I think of it as a love letter to your family, because you're literally saying, I love you so much. I'm doing this extremely selfless act of making sure my finances and my estate is in order, so you don't have to deal with it as hard as it's going to be with everything that's happening should you pass away. Once you've got all of that taken care of, we get to invest. And the first one, the easiest one, is to start participating in your employer-sponsored retirement plan if you are eligible. We know of this as your 401k, your 403b, anything at your workplace where they're saying, here, this is your retirement account. That's where you can easily start investing. And in fact, 9 times out of 10, there's a match by your employer, meaning that if you put some money in, they will also contribute some money. That is free money. I can't stress enough how important it is to at least put enough in to get that match. So if they're matching 3%, make sure you're at least putting in the 3%. The way the match works, you have to put in enough to be able to qualify to get the full amount of that match. If they're matching 5%, be putting in at least 5% of your gross salary so that you can get that match. Second is opening an individual retirement account. This is a little tricky because there are some very specific rules if you have an employer-sponsored retirement plan. Let's say you do not have an employer-sponsored retirement plan. You don't have a 401k. You don't have any retirement account at your work. Then number 2 is a no-brainer. Then you can open an IRA and start putting money into that immediately. You don't have to worry. If you do have an employer-sponsored retirement plan, please be sure to check with your accountant about your income limits before you start opening and contributing to an IRA specifically. So the first 2 really on starting into invest are based around funding your retirement account. And so your retirement, right, is providing for that future when you are no longer working. That's a long time away. And even if it's not that long away right now, it's going to be a long time horizon once you're in it. So there's a long time period for those retirement funds. Number 3 is for contributing to a college savings account. This usually has a specific end date of when you're going to need that money. It's a very clear time horizon because the person you're contributing for and investing for will probably be going to college at a specific age. That likelihood is high. And so contributing to a college savings account can be a great way to grow those funds in the investment world without having to work quite so hard to put as much into savings for that college fund future. And number 4 is investing in taxable accounts. So what is a taxable account? Basically, it's in your own name or a joint name with your spouse. And it's a way to invest in the markets and in all of the different asset classes that's in your own name. There are no benefits like with the retirement account or the college savings account. It's specifically simply for investing. This is the location of where you're going to be, the type of account that you're going to be investing in. In a retirement account, you get benefits when you start investing into those. Usually, if you're in a traditional retirement account, you get a tax deduction of the same amount as what you contributed. So let's say you're making $100,000 and you contribute $6,000 to your employer retirement plan. Now you're only showing up on your tax return and you're only taxed on $94,000. A college savings account, that's after-tax money. So you've already paid your taxes on it and then it goes in. But all of the growth on that account, all of the investment growth comes out tax-free if it's used for specific college expenses. Taxable accounts don't have those same benefits. What they do have is that the investments inside have specific tax characteristics that we'll discuss as well. But those taxable accounts, they can be used and accessed immediately. Your retirement account, you usually can't touch until 55 or 59 and a half. 55 if you retire from the employer at which you had that plan after age 55, 59 and a half for everybody else. The taxable account you can touch immediately. So let's say you want to save for something that's 15 years from now and you're willing to take a little bit of risk in the market. The taxable account could be the right fit for you if you won't yet be 59 and a half to be able to withdraw it from your retirement plan. There are some specific details here. We don't have time to go through every single one. So definitely check with your advisor or your tax person before deciding all of these best steps for where your assets should be located. The next step is to create an investment plan. We've talked already about the time horizon, meaning that retirement is a long time away, right? So that's the first step, is understanding what the goal is and how long you have until you're going to meet that goal. And it's very clear if you're choosing the account that fits that goal, right? If it's a retirement account, then it's going to be for retirement. That's going to be your investment goal. And it also helps to dictate how long you have until you're going to need that money. And that's step 1, is in any investment decision, you want to make sure you identify what the goal of investing this money is and how long you have for it until you want to be able to use it. Number 2 is, how do you balance your risk and return, right? And so we're going to talk about those 2 aspects here in a moment. Number 3 is creating an investment strategy. So once we understand how risky we want to be versus how much return we want to really create, then we create the strategy of how we're going to do that, what's going to happen to build that portfolio. And then number 4 is to actually choose the specific investments inside of that portfolio. And then number 5, monitor and update your portfolio. This is not a set it and forget it type of situation. We definitely need to check back in on this. Risk and return. As I mentioned, we were going to get right to it, right? So here's risk. Risk is the possibility of losing money. Usually, the riskier it is, meaning the higher the likelihood that you could lose some of the money that you're investing, the greater the potential for return, the greater the upside is. But it also means the greater the loss. So the more risk you take, you could earn more, but you could also lose more. Return is what you actually get back as a percentage of the amount that you invest. So if you're limiting your risk, then you will limit your return and your potential return, but you would also limit your potential loss. And it's very important to recognize how much loss versus how much upside you're willing to take. Humans have a tendency to feel loss a lot more than they feel gain. And so you want to be very clear about how much loss you're willing to take, because our investor behavior, or how we react as humans to those loss experiences, can be very impactful, and it can really throw off our investment strategy. So you really do want to be very clear about how much money you're really willing to lose in the time horizon that you've got. Here are some questions you can ask yourself to identify your risk tolerance, right? And so if you go through, I'm going to be quiet just for a minute to let you think about the answers for this for yourself. So as you think about these questions, it's important to understand whether or not, right, which one of these might be riskier, right? So if you are willing to lose some principal in pursuit of a higher return, then yes, you're more willing to take risk, right? If concerns about your investments keep you awake, and that's a yes, you might be a little bit more nervous. And that's really where these colors come in too, right? And so then do you make changes to your investment account every time the market drops? If that's what's happening, maybe you're not as okay with that risk. And certainly also if you monitor your account frequently, that could also be a sign that you don't really enjoy the risk experience too. It's important to recognize your own behavior and your own pattern, because your experience of your investments is going to be directly correlated to how often you're looking at them, how concerned you are about the potential downside, and how far out you still have before you're going to need this money. It is important to realize that the markets gain and lose value in recurring cycles. So we see those cycles play out, and that it's important to realize what the ups and downs could be, and that it's not usually going to just stay in one of those two positions. It is cyclical. The only return that you'll really get on that insured account in your savings account is going to be limited by the interest rate that they're paying. And as we just talked about, that is about 0.5 to 0.6 on the high end these days. So you want to understand what you can actually expect to earn from various types of investments, right? Each different type of investment has a different return possibility. And so let's actually take a look at these different kinds of investments. There are stocks, bonds, bills, which is really very short term, very, very safe investments, and then what inflation actually is. And this is a great chart because it shows you exactly what will happen as you grow of $1 in the past 94 years. So it shows you a variety of different options, right? So small stocks are on the top, they're the dark blue. Large stocks are in the middle, that like lighter blue. Government bonds are the orange, treasury bills are the green, and then inflation is that gray at the bottom. So let's break this down to really understand what's going on, right? So inflation, let's start there, that we're going to build our way up on this chart. Inflation is the increase in the cost of items, of goods and services over time, right? And we see this when we think about how much a loaf of bread is worth today versus how much it was worth 30 years ago or 50 years ago. Or how much a house costs today versus how much it cost 30 years ago. Ask anybody who bought a house 30 years ago how much they paid, and then think about how much it's worth today and how much somebody would pay for that today. That is inflation at work. It's the increase of cost over time, right? And so that inflation is growing over time. And typically inflation is somewhere around 2.9 on average, 2.9%. And so when we think about that increase over time in the cost of goods and services, we want our investments to at least be keeping up, if not growing more. Because if they're not at least keeping up with inflation, how much will it actually be able to buy us in the future? It will actually be worth less, right? So when we think about $1 in 94 years ago is actually worth $14 today. If that $1 we left it in a savings account earning 0 interest, we'd still have $1 today. We wouldn't have the actual value of $14, right? So that's important to understand to begin with. Treasury bills are very, very safe investments. They're written by the Treasury Department, and they have got this beautiful upside here of 3.3%. So at least you're going to be keeping up with inflation in those Treasury bills. Government bonds historically outperform Treasury bills a little bit and help keep pace with inflation. But really where you see the upside is in the stock market. And you can see when you look at each of these lines, look at the ups and downs in those lines. This correlates directly to that risk and return conversation we just had. The risk of losing money is a lot higher with the things that go up and down, but those are also the things that have the most upside potential as well. Looking at the very beginning of this chart, right, where you can see the stock market crash in 1929, and you see that the stocks really lost a huge amount of value. And if you were experiencing that as an investor and you had entered with $1 at the beginning, and then you saw that value just drop so significantly, it would have been hard to stay invested. And yet, had you kept investing and stayed the course, how much would that $1 be worth today in large stocks? $9,244. How much would it have been in small stocks? $39,381. And so you do get paid for taking this risk, but you do have to live through the volatility. And it's this aspect of it, and there's no guarantees with investing, right? This aspect of it is what makes it tricky because we are human and we do experience this emotionally as well. So let's put this into perspective, right? And so these are by different decades, what the actual annualized return was, and also the standard deviation. Standard deviation is the up and down, how much it deviated from the norm, from the standard. And so annualized return there, you can see each decade how much it grew. The S&P 500 index grew each of those decades. And there are certain decades where it didn't grow a lot over that period of time in terms of the annual return. In fact, there are some decades where it was actually negative, 2000 to 2009, for example, and so even as we look at this, you can see that there are going to be ups and downs, and that is going to demonstrate some volatility. But over time, and this is why that retirement time horizon is so important, of how long do you have, how many decades do you have before you're going to need that money, and then once you're in the retirement, how long you're going to have while you're still going to be using that money. You're not going to take it all out that first day of retirement, right? And so that volatility of the investments can be both a benefit and a downside. I want to make sure we understand how this works together. So let's take a moment to understand that portfolio from a perspective and understand some of these words. I want to take just a moment to step back and explain each of these words. Stocks, right? Stocks are investing in companies as an owner of the company. So when a stock is something that you own, you are actually a co-owner of that company, a very, 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 very tiny, tiny, tiny co-owner of that company. That means you get to enjoy the upside of that company as it grows, but it also means you are open to the downside of that company in case it were to go bankrupt. So stocks have that volatility pretty significantly. They are ownership of a company. Bonds, on the other hand, are debt of a company. So when a company is looking to do to raise money or do a project or do any sort of get some money into its system, it looks to borrow. And who does it borrow from? It borrows from investors in the form of bonds. So if you own bonds, they owe you money, and they will pay you that money back at the maturity date of the bond. The maturity date of the bond is when that bond returns back the capital that you put in, the principal that you put in. While you're holding onto the bond, you get paid interest. And that interest that you get paid, that's often the upside of the bond. Plus, there can be some price fluctuation, although it's much, much smaller than with the stocks. So there is some price fluctuation with bonds as well. And so this demonstrates here the annual total returns from 1950 to 2019 of stocks, bonds, and a blended portfolio. And a blended portfolio is if we took a pie and we cut it right down the half, we're looking at down in the half, we're looking at a 50-50 portfolio. Half of the pie is in stocks, half of the pie is in bonds. That's the portfolio. And so if we mix those two together, we get this annual average total return of 8.9%. So this shows you the growth of $100,000 over 20 years at these different annual average total returns. So the average annual total returns are from 1950 to 2019, but then we're taking only those average returns and growing $100,000 over 20 years. So you can see stocks actually give you quite a significant upside. They also go for quite a ride, as we saw on the previous couple of slides. And bonds are much safer, but they have a much lower return. So when you blend those two together, you get a pretty, still very sizable return while not experiencing all of the volatility that the stocks have. All right, wonderful. So asset allocation. Asset allocation, we're going to go back to our pie. Our pie is the portfolio. So let's say you put $100,000 into your portfolio. Think of that $100,000 as the totality of the pie of your portfolio. So as we take that pie, we're going to actually cut it. So the first cut we're going to make is that 50-50, right? How much is in stocks versus how much is in bonds. Once we've got how much is in stocks versus how much we're going to be putting into bonds, we might also put a little bit into cash, right? Keep a little bit of that protection. And when we combine those two things together, then we are able to see, okay, this is how much is in each of those different asset classes. Stocks and bonds are each an asset class. Then we can go ahead and slice that pie even further. So on the stock side, how much do we want in the United States stocks? How much do we want in the European stocks? How much do we want in emerging market stocks? How much do we want in Japanese stocks? So we are able to slice it into those different slices. Then we have to choose again, how much do we want within the United States into extremely large companies? Those are called large cap stocks. How much do we want in middle-sized companies, mid-cap stocks? How much in smaller companies, small cap stocks? So we slice that portion of the US side, of the stock side of the pie a little bit further. We cut those pieces a little bit smaller to show how much are in US large cap, US mid cap, US small cap. And we do that for each of our asset classes. We do this for bonds too. We talked about government bonds versus treasury bonds. There are also corporate bonds issued by corporations, and there are municipal bonds as well. So we're dividing that pie, and that is called asset allocation. What we're putting into each slice of our pie, how much is going to be in each of those slices, that is creating an asset allocation. And when we do that, it helps to control our risk without necessarily reducing the potential return. When we're in lots of different things and they're not all in one company or not all in just one place, then we are going to have a different return or a different strategy. We're going to control that risk because, everything is going to be acting differently. It's not necessarily all going to go down at the same time, right? So how a government bond from the US government reacts might be very, very different than how a Japanese tech company reacts, right? And by having that combination of different things, it gives us that risk protection and helps us still be able to access that potential return. So when we invest in lots of different asset classes and we divide our principal amongst those asset classes as a percentage, that's choosing the slices, right? You can imagine this pie chart with lots of different colors with each of the different slices. That's helping to create that asset allocation. And so this is an example of that pie, right? So this pie, we've got 65% into stocks and stock funds, 25% into bonds and bond funds, and 10% into cash. And so this pie, then we are going to be able to then take and cut even into further slices within each of those bigger chunks of the pie to be able to clearly identify what's going into which piece of the markets available. And so choosing that asset allocation is actually one of the biggest predictors of your future return. It's important to recognize that asset allocation helps you to protect your risk, and it also helps you to make sure that the experience you are having of your portfolio is going to be a positive one and will only be of one particular asset class or even potentially one particular company. So we want to have the experience of lots of different things and not just be risking everything on one particular investment. So typically, how we look at the asset allocation picture, we want to take a look at how old you are and your time horizon and how much risk you can take. So remember when we did that risk tolerance questions at a few slides ago, we want to take that information, add it into how long we have until we're going to be using this money, and that can help inform the asset allocation, how we're going to slice the pie. If you're younger, typically you can take more investment risk and allocate more to stocks and stock funds. So your portfolio might be riskier than somebody who's on the older side and getting closer to that retirement picture. They may want to decrease their risk and put more towards bonds and bond funds so that their experience isn't as volatile, and because they might be withdrawing that money sooner, so they don't want it to drop potentially or have as much of that volatility at work as with stocks. So that really does help to explain the time horizon and that importance, right? If I'm 35 and I've got, till I'm 65 to retire, plus then I'm going to live until I'm 85, I've got a 50-year time horizon. If I'm going to be, 60 next year, maybe I've got 5 years until retirement and then another, hopefully 20, 30 years in retirement. But I've got a different time frame than the person who's going to be 35. There's no right or wrong answer here, and there are definitely exceptions to the rule. I've seen people who are younger, who are very risk averse and can't really experience that volatility, choose to be in a higher percentage of bonds. And I have a client right now who's very, very into stocks, and both can work, but it's very important to understand your own ability to withstand that risk and how long you have with these assets. It's also true that if I'm on the younger side and perhaps I'm saving for a house and I decide to invest some of that money, but I want to take it out to buy my house in 5 years, think about how short that time frame is. If I put that amount, as is shown in this pie chart, into stocks, and then in 5 years, right as I'm trying to buy a house, we see a pandemic hit, then I might see a downturn in my investments right at the exact same time as I'm trying to take that exact amount of money out to buy a house, perhaps. Or I might, be hoping to do a vacation with this money or take a sabbatical. And if it's in a short time horizon and I'm still young, I might think, oh, I can go ahead and take more risk in order to make this happen. But it's important to recognize that it does matter how much time you have until then. Diversification, this is basically that combination of all those different slices of the pie, right? When we've got that asset allocation, how we're slicing the pie is that experience of diversification. So long and short-term bonds, large and small company stocks, international and emerging market stocks as well. And that's, U.S. stocks should also be here. There's large and small company stocks can be in the U.S. They can also be international and emerging markets as well. So taking that asset allocation of how much is stocks versus bonds and then diversifying within that, right? That's cutting that pie into pieces and spreading it around in each asset class. You can do this by combining different individual securities, by purchasing different individual stocks. You can also use mutual funds. You can also use exchange traded funds. Mutual funds and exchange traded funds are a basket of individual securities, right? And so whether that's bonds or stocks, those are called securities. When we talk about them as a whole, those are securities, either bonds or stocks. Mutual funds and exchange traded funds pull together lots of each of those and allow people to buy a piece of that fund. And so the mutual fund is typically run by a mutual fund manager. That's a person or a team in charge of the choosing of those individual securities inside of that fund. Your experience as an investor is of the totality of all of those individual securities. You're not going to be invested in just one of them. You're going to be invested in all of them, and how they do combined is going to be the return of the mutual fund. An exchange traded fund is the same idea, the basket of individual securities, but rather than having an individual manager or a team of managers up at the top, usually exchange traded funds are following an index or a portion of an index. We talked about the S&P 500 before. That is an index. It's passive. There's nobody picking and choosing what happens or which stocks are in it each day. Instead, it's simply 500 companies and how they do day by day. An exchange traded fund that's perhaps an index fund following the S&P 500 is going to mimic the return of that S&P 500. If we choose that type of a fund, it's much more passive. It's going to act like the index that it's following. It's going to be an experience of the market. You're not going to have somebody who's in charge of the fund choosing what to do. You want to understand how each new investment adds to your diversification. So I've seen this too many times to count, where somebody thinks that by choosing lots of different mutual funds, they are getting different diversification. But if all of the mutual funds they choose are just different mutual funds that have large company stocks that are US large company stocks, they might end up with 5 different mutual funds, and each of them has a pretty significant amount of Apple or Facebook or Google, because those are the top companies in those funds right now. And so you want to understand how each different investment you're choosing adds together to create the diversification in your portfolio. You want to identify investments that have the potential to deliver at the return that you're looking for, and you need to do your own research, right? Ultimately, your decision is based on your own decision of what's right for you. You can also work with your financial professional to help build this portfolio and choose your investments. And you want to choose the ones that actually fit your asset allocation, thinking about that pie, and then choosing how we're going to slice that pie, figuring out that diversification within the pie. You don't want to make these mistakes. Do not concentrate all of it on 1 or 2 investments. I can tell stories about folks who had all of their money in Edison stock when they retired, and then Edison took a dive at the beginning of the 2000s, and suddenly their entire retirement portfolio went down with it. That is extremely risky. It's extremely risky to put all of your money on 1 or 2 investments or 1 or 2 companies, even if you work at those companies. And in fact, particularly when you work at those companies in some ways, because your income is already tied to those companies, to that company. So understanding that by concentrating on just 1 or 2 investments, you are going to have a much, much higher risk of that particular investment going bankrupt. Thinking back to our pie again, and if we had cut it, sliced it all across and in all a bunch of different asset classes and diversified it, what happens if one of those investments is Edison and it goes bankrupt or goes way down, right? So if that's the case, then the rest of your pie is still there to help build your portfolio and help to continue to grow and help to provide that protection. And so that's the point of diversification, right? That's the upside of making sure you're in lots of different things. Don't put money into investments you don't understand. So I know this is investing basics. Ask questions as they come up that may help to clarify all of this for you, and also make sure to talk to your financial planner on Saturday when you come talk to us about what investment questions you might have. And don't overload on company stocks, right? We just talked about how if you're only in Edison and you work for Edison and you've got all your money in Edison, you're really concentrated risk. And then don't chase hot performance. This is how bubbles happen. This is how we end up constantly looking for the next best thing, and the grass is always greener, right? We hear these stories in our field of folks who are trying to get the best mutual fund performance. So they keep switching their money into the mutual fund that performed best the past year. Well, they performed best the past year. Doesn't mean they're going to perform best the next year. So don't chase hot performance. Do what's right for your portfolio. Do what's right for your investment time horizon and risk tolerance and all of the things we talked about here. Here's what does work. Invest early, invest regularly, and automatically. Automatically means put that contribution into the 401k at your work. Make sure it's regular, it's automatic, it's happening every month or every pay period. Dollar cost averaging is buying into the market a little bit at a time over time. And what that means is if I buy into the market right now and I buy in 2 weeks and I buy in a month and I buy in a month and a half, I'm going to get slightly different prices for each time I buy in. But overall, it'll average out. And that experience means that I'm not risking it all on black, basically. I'm not putting it all down at one time. Putting that direct deposit from the paycheck is important, and staying in the market, right? When we were looking at that chart with the volatility over time, what happens if you had gotten out during, 1929? Yeah, it would have been pretty tough. It's really, really hard to choose when to get out and when to get back into the market, especially if you have clarity around the long-term time horizon that you're investing for and you're doing all of the things that we talked about before. Riding through that volatility is what helps to pay off at the end, right? And granted, there are no guarantees in investing, of course. So let's talk about the time value of money, right? So the impact of investing grows over the years because of compound growth, right? So if I've got an average annual return of 7% on my $10,000, those first 10 years I'm growing that at 7%. But for the next 20 years, so for the next 10 years, see how it's grown even more than that 19,672 in the original first 10 years. That's because that money earns interest. Our interest earns interest. So what we're building over time is worth more in the future usually, and we're allowing our average annual return to compound our growth and really allow it to grow tremendously. And so that 7% return allows me to really see that trajectory. Look, 19,672 up to 38,000 up to 100,000. And that is this huge arc that we can see when we are allowing our money to grow and for that interest to earn more interest. Make sure that you are aware of the investment expenses that are coming up for your investments. There's a lot of hidden fees and hidden costs. Understand them. Look for the words expense ratio. Expense ratio speaks specifically to the investment expenses. Be aware of the taxes that are happening with your investments, but they shouldn't dictate your investment strategy. So taxes are an important piece of this, but you also want to understand how each of those work. We haven't gotten into all of the tax characteristics of stocks versus bonds and the time horizons here today. It's something you can definitely research online, and we can talk about on Saturday as well. And then rebalance your portfolio and monitor it ongoing. Make sure that as you are thinking about, right, how much things are growing, if stocks are growing faster than bonds are, eventually stocks will be worth more in your portfolio as a percentage than the bonds will be. So we want to rebalance your portfolio to get back to that asset allocation, that beautiful sliced pie that we keep talking about, to make sure that it makes sense for your investment allocation and your time horizon. Things change, right? And so you will see these investment plans evolve over time. Your goals might change, your attitude towards risk and return might change, how your finances are working could change, the economic situation could change, and you could also become more experienced. This is the basics we're talking at the beginning. Let this be an opportunity for you to be curious, for you to be open, and for you to learn. And looking forward, this is a voyage of discovery. A single mistake is not fatal, and you can learn from this experience, and being able to learn from your experiences is essential. And so as we think about investing moving forward and using all of the concepts we talked about here today, we are able to really to take that sense of curiosity and discovery with us and use it to start to get better and become that more experienced investor. So here's the summary of what's going on here. Professional expertise can help you make decisions. That's why there are people who do this work and that are in this field. Your situation is unique and it should be treated as such. You are not just a tick box or a check box or a number in an account number, right? We want to make sure we understand the situation that's specific to you with regards to your particular investment time frame, horizon, all of the good stuff. And you're ultimately responsible for your investment results. It's important to ask questions, not to be shy, not to shy away from making sure you understand what's going on. Be detail oriented and make sure you know why things are happening in your investment portfolio. This should be a key characteristic as you start to grow into becoming a more experienced investor. Here are a couple of recommended reading items. John C. Bogle is classic Stay the Course, the story of Vanguard and the index, and the Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns. Bogle has written those two books, and we definitely recommend that if this has made you curious at all to understand more about investing. And then Christine Benz has a couple of different options here as well. The Morningstar Guide to Mutual Funds, 5-Star Strategies for Success, and the 30-Minute Money Solutions. And a couple options to get help. You can always find a financial planner that can help you. onefpa.org. FPA is the Financial Planners Association, of which I am a member, and is the organization helping to put on this wonderful, wonderful program this week. And then the www.plannersearch.org, which is a CFP site as well. And this is where you can find a large number of qualified planners, and it gives you options to figure out who's the right choice for you by searching and filtering correctly. And you can also find planners who offer a free initial consultation. Plus, there's even a list of questions, so you can ask those planners and vet them, so you can make sure you choose the financial planner who's right for you. Always double check the disclosures of the person that you're speaking to at BrokerCheck by FINRA, brokercheck.finra.org. Important to make sure that the person you're talking to is qualified and that they don't have anything going on in their history that could give you cause for concern. And that's it for our presentation today. I appreciate your time today. And there are a couple of other free resources to start building your own financial plan as well. You can definitely look at the ffpprobono.org consumer resources section, and there is a great resource there. And you can also start to make sure that you're putting your financial picture in order, really taking control of your financial situation and looking at everything in totality.
Thank you very much, Katrina. We have a couple questions from the chat, so I'm going to read you the question. The first one is, if you are splitting your investments 50-50 between stocks and bonds, why isn't the return the midway point between investment class alone?
Yeah, that's compound interest at play for sure. We begin to see how compound interest plays out over time. And when stocks are earning interest that earn more interest in more stocks, that kind of grows those experiences over time and grows those asset classes over time. It's also a little bit off from the actual average because, right, we also have to take into account just how that chart is being designed, of course, as well. So that compound interest plays a big part in the shift from just a straight average over time, because you're able to grow those assets over time.
Okay, thank you. And the next one is there any way to get a higher interest rate for your emergency fund and still keep it liquid and easily accessible? General saving accounts interest rates are so low.
Yeah, I know. I wish there was an easy way to be able to get lots more interest. If we knew what that was, I'd be doing it too. I would say, generally speaking, you can always look online for a higher yielding online savings account. You do still want it to be a savings account or a money market account. And unfortunately, given the interest rate environment we're in, it's hard to find a safe investment that's paying a lot, right? This is just part of the risk return characterizations of investing. If it was paying more, it'd probably be more risky. And so that savings account, the highest yield that you can really find, the highest interest rate that you can find is usually by doing some research into high yielding savings accounts. Sometimes you're able to find those with online savings vehicles. I know there's a variety online that I found that have been in that 0.5 to 0.6% interest range. And then there's also your credit union could have options for you as well if you're a member of a credit union. So a couple of resources there. I don't know that there's a great answer. I have not seen of anything that's paying 1%. So if anyone knows of anything, please let me know. I'd be happy to hear it. But you want that savings account to be safe. And just given the interest rate environment we're in right now, there aren't a lot of options. I'm so sorry.
Thank you. And there's a question we answered in the chat. I'm just going to ask again here. How can I find assistance to help create a financial planning?
Yeah, so if you're looking to create a financial plan, obviously this week is all about helping you do some of that financial overview and financial planning. So you can definitely sign up for an appointment on Saturday to speak to a certified financial planner for free through the LA Public Library. And then there's also those additional resources we mentioned at the end of the presentation with onefpa.org and plannersearch.org that are able to give you the resources to actually find a qualified certified financial planner. And so those two, onefpa.org and plannersearch.org, are both going to be able to give you the resources to find that person who can help you.
Thank you. I don't think we have any other questions. Thank you very much, Katrina, and thank you everyone for joining us this evening. For more information about the upcoming workshops and to sign up for the free one-on-one telephone consultation on Saturday, please visit our website, lapl.org/financial planning. Thank you again and have a great evening. Bye-bye. Yes.
Michelle, I think we have one more question.
Oh,
How does the national debt affect the stock market and the GDP too? And I think, unfortunately, this question is very wide ranging, and there's a lot of different answers here, and there's a lot of different ways that it can impact the stock market, right? This is all really tied together when we think economically about how we're having to repay that debt, and what companies are having to do, how taxes work, and then also how we think about the cycle of the debt issuance. So national debt definitely does impact the stock market. It can impact it positively, as we've seen with the coronavirus response right now. The fact that there has been so much support provided by the government, they had to fund it somewhere and somehow. And so we are, in fact, in more debt as a result of this. And then that allows the stock market to feel safer, though, because there's additional liquidity in the markets, and that there is that underpinning by the government and that support. However, it can also create this, can that we're kicking down the road, where eventually we have to repay that debt. And how are we going to be able to do that? So I think when we think about the impact of the national debt on the stock market, it can be both positive and negative. Right now, it's having a positive impact because we are in a crisis mode, and it's been necessary to get our economy and our country through this process. It's also something that will potentially impact it negatively as we attempt to repay that debt over time. And certainly, as we think about some of the different economic indications from different companies that are trying to potentially move their headquarters abroad versus stay in the United States versus taxes, there are all of these kinds of considerations that interplay together. So there's not like a clear, easy answer. But I would say for right now, we're seeing that underpinning of liquidity from the federal government really upholding the stock market and upholding the overall economy as well.
great.
Awesome.
Thank you. Yeah, please visit our website, lapl.org/financial planning for more information. And thank you again. Have a great evening.
Thanks, everyone.